Hey everyone, with festive seasons right around the corner, buying gold is a huge tradition for so many of us. But here's a thought. What if the way we've always been buying it isn't actually the best way to grow our money? Let's really dig into that today and figure out how to be both traditional and a really smart investor when it comes to gold.
I know, that sounds like a crazy statement, but honestly, it's true. Over the long run, these tiny little details in how you buy gold can add up to a huge difference in what you end up with. So we're going to break down exactly what those hidden pitfalls are, and more importantly, how you can sidestep them completely.
You see, at the heart of all this is a kind of tug of war. On one side, you have gold as this deeply emotional thing, right? It's about tradition, festivals, that feeling of a safety net. But on the other side, if you're looking at it purely as an investment, you got to think about returns, efficiency, and costs. The real key here is realizing that these two very different goals probably need two very different strategies.
Okay, so this is where it gets super interesting. Because when you first look at the performance numbers on paper, you might actually jump to the completely wrong conclusion. Let's see what I mean. Just take a look at these numbers. If you look at the compounded annual growth rate, the CAGR, over the last 10 or 15 years, physical gold actually looks like the winner, doesn't it? It seems to beat out both gold ETFs and gold funds. So that's it then, right? Case closed. Just buy jewelry and you get the best return. Well, not so fast.
And this quote right here, this is the whole point. Those on-paper returns, they're just one piece of the puzzle. They show what's possible in a perfect world. But we don't invest in a perfect world, do we? We invest in the real world, and that world is full of hidden costs.
So it's time to pull back the curtain and meet the real villain of this story. All those costs that are quietly chewing away at your investment from the second you buy it. Okay, check this out. When you buy a piece of jewelry, a huge slice of your money, we're talking anywhere from 5 to 20%, doesn't actually buy you any gold at all. Nope, it goes to something called making charges. That means right out of the gate, on day one, your investment is already down by that much.
Now look at the flip side. With a gold ETF, an exchange-traded fund, pretty much all of your money, like 99.5% of it, is going straight into buying gold. The cost, which they call an expense ratio, is tiny. It's just a fraction of a percent. The difference in how efficiently your money is put to work is just, wow, it's massive.
So here's a quick rundown of our three options. You've got physical gold, which is high on emotional value, but also high on costs. Then there are gold ETFs, super efficient, they track the gold price really closely, but you do need a DMAT account for them. And finally, gold mutual funds. They're all about convenience. You can do SIPs, no DMAT needed, but they cost just a little bit more than an ETF.
All right, enough with the theory. What does all this actually look like in the real world over a long period of time? Let's run the numbers and see just how much of a difference these seemingly small costs can make.
So here's our scenario. Let's say we invest 5,000 rupees every single month for 15 years straight. That adds up to a total investment of 9 lakh rupees. Now, let's see what happens to that 9 lakhs down each of our three paths. First up, physical gold. Now, even if we assume the market does pretty well, once you factor in those pesky making charges on every single purchase, our 9 lakh rupees grows to somewhere between 15 and 18 lakhs. Okay, not bad, but let's call this our baseline. Let's see what the others do.
All right, next up, the gold mutual fund. Because the costs are so much lower and you get that power of systematic investing, the same 9 lakh rupees now grows to between 18 and 20 lakh rupees. That's a pretty serious jump, and you get all the convenience.
And finally, the undisputed champion of efficiency, the gold ETF. By keeping those costs down to almost nothing, that very same 9 lakh rupee investment explodes into a massive 20 to 22 lakh rupees. I mean, that is the raw power of keeping your costs low over the long term. So here it is, the final verdict, all laid out side by side. The difference between the least efficient way and the most efficient way to invest isn't just a few thousand rupees. We're talking about a gap of 4 to 7 lakh rupees. That is literally the price you pay for hidden charges. That's why this matters so much.
Now look, this does not mean you should never buy beautiful jewelry again. Of course not. It just means we need to be a little smarter about it. We need a clear strategy that separates our emotional buys from our serious investment goals.
And this is that strategy, plain and simple. It's about matching the right tool to the right job. For emotion, for festivals, for giving a gift, go ahead, buy the jewelry, enjoy it.
For convenient, disciplined investing through SIPs, especially if you don't have a DMAT account, the Gold Fund is your perfect match. And for pure, no-nonsense wealth creation where you want to squeeze out every last drop of return, the Gold ETF is the clear winner.
If there is just one thing you remember from all of this, please let it be this. The underlying price of gold is the same for everybody. But the actual return that ends up in your bank account, that is decided entirely by the method you choose to invest in it.
And of course, just a reminder that this conversation is for educational purposes. All mutual fund investments have market risks, so it's always a good idea to read the offer documents carefully and maybe chat with a financial professional before you make any decisions. Thanks for tuning in.